and good morning, guys. Welcome to another fabulous episode of Exit Strategies Radio Show. Guys, I am your host, Colin J. Millett, broker and owner of Exit Realty Group in beautiful, guys, North Charleston, South Carolina. So if this is your first time listening to this show, you, sir or ma'am, are in for a treat because our mission here is very simple. That is to empower our community through financial literacy and real estate education, guys. We are legacy building. That is what we do. So, guys, look, today is another fabulous episode. All right. If you've been tuning in, you see where we're going. We're taking you guys to higher heights, to higher levels, so we can do higher things. All right. So that's what this thing here is all about. And today is no different. Guys, we have with us today, look here, let's give a drum roll. Erik Oliver with Cost Segregation Authority. So, guys, I want to give you a smidgen of an introduction of Erik and what he brings and the information he's going to be dropping on us, guys. So I'm going to prepare you during this time. Please make sure you go grab a pen and a pad because you want to start making some notes on some of the things that he's going to be talking about today because it is going to blow your mind, all right? So Erik Oliver holds a Bachelor's of Applied Science degree in accounting, all right? So prior to joining where he is, the company where he is now, the Cost Segregation Authority, he was an operations manager for a multi-million-dollar landscape and design firm, guys, in Long Island, New York. So he's up there in that cold weather. So hopefully he won't bring that wherever you are, all right? So look, his talking points, guys, what we're going to be touching on today, guys, is some high-level stuff, and we want you to make sure that you get your pen, your pad, and start making some notes. So Erik, guy, thank you so much for being with us today on the show. How are you doing?
Oh, good. Thank you for having me. I'm glad to be here. Looking forward to it.
So if you don't mind, tell our listeners what you do.
That's a great question. This question for my kids all the time. They're like, Dad, what is it that you do? You're gone all the time. I have no idea what you do. So I'll try and break it down as simple as I can. What we do is we're kind of a niche accounting firm here at Cost Segregation Authority, and we work with CPAs and building owners across the country, reducing their tax liability through engineering-based studies called cost segregation. And what cost segregation is, it really is just accelerated depreciation. So depreciation is a non-cash expense, which is a great non-cash expense, right? So if you buy real estate, you're allowed to write off a little bit of that real estate every year over the course of either 27 and a half years or 39 years, depending on the type of asset you purchase. So 39 years for commercial buildings, 27 and a half years for residential units. Instead of taking 1/39th of a deduction over 39 years, I'm not going to own my building in 39 years. Hell, I might not even be alive in 39 years. I hope I am. The way I eat, I might not be. So I want my deductions now. So give me my deductions now versus in the future. And so the way that's done is by doing the cost segregation study. When you buy a building, you don't just buy the land and the walls. You also buy a little bit of carpet. You buy a parking lot. You buy some window coverings. You buy a conference room, some cabinets, some different components. The IRS, for example, says carpet should be depreciated over 5 years, not 39 years, which makes sense. Carpet doesn't last 39 years. Your structure does, your building does, but your carpet doesn't last. Yeah, hopefully, depending on the part of the country and the weather patterns. But yes, hopefully it does last 39 years. But by allocating the sales price, or excuse me, by allocating the cost of your building into these different buckets, it allows you to accelerate the depreciation so you're not spreading it out evenly over 39 years. You're getting a bulk of it in the early ownership of that property. As you know, Corey, there's a number of reasons why we would want to do that. You know, time value of money, inflation. I want my dollars today versus letting the IRS hold on to these for future use. I want mine now so I can go pay down debt, so I can go buy a new property. Give me my money now. And so that's why people oftentimes will utilize cost segregation when they own real estate.
So that's interesting. So, you know, for our listeners, guys, what we're talking about is just kind of breaking it up. So taking the building, taking the components of, and this what's interesting is there's a full schedule. So what I just heard you say, Erik, man, there's a full schedule with the IRS that says for this, you can depreciate over this time period, so forth and so on, which may be, will be, should be considerably less than depreciating the entire asset. I'm assuming most CPAs do just straight line depreciation.
That's correct. Yeah. You think about CPAs. CPAs And you brought up a good point. I'll get back to that. But there's actually a book that's like 1,700 pages long that tells you how to depreciate everything that you could possibly ever want to depreciate. It has a schedule. It says carpet lasts this long, cabinets last this long. So CPAs, when I buy a building and I spend $1 million on a fourplex and I go give my closing statement to my CPA, my CPA has no clue what the parking lot's value is. All they know is I bought that building for $1 million. But they don't have any specialty training, or they don't have a background in construction to be able to go in and say, okay, well, of that $1 million, 100,000 of that was for a parking lot. 40,000 of that is for the carpet that's in there. And so that's where a cost segregation study comes in handy. Is we break out that one line item that normally just says building on the depreciation schedule. We break it up into a number of different parts, which allows you to front load those deductions and take them sooner.
Hold on, guys. Look, if y'all see me, my top of my head is slowly raising. There's smoke, there's steam coming out because this thing is about to blow. So let me ask you this. So let me take you around, Erik, to the CARES Act. So if you don't mind, I know that's something that that you guys are well versed on, how to find opportunities for investors within there. So if you don't mind, number one, tell our listeners what the CARES Act is. Some people don't even realize what in the ham sandwich it is.
Sure. So the CARES Act is the Consolidation and Appropriations Act. And it was basically the COVID package that was passed. So there was some laws. The government said, hey, there's some obviously economical issues that are associated with COVID. And so they passed some legislation, and a few things happened. One is they extended the 179D deduction. So I'm going to talk about two deductions and credits that are important for your listeners to understand. One is 179D. Now, what that is, that's a deduction if you are constructing commercial real estate and it's new construction. You may be eligible for a deduction if your commercial real estate is energy efficient. And so that was one thing that was extended. That had been around before the Consolidations and Appropriations Act, but that was extended indefinitely as part of that act. So that's something to be very much aware of, because it's one of the most underutilized real estate deductions that I'm aware of. Nobody seems to know about it. Even CPAs don't know about it. And so if you're building new construction and you have a third party come in and deem that new construction is energy efficient according to the IRS standards, you're eligible for $1.88 per square foot of a deduction for 2022. And they actually increased that number for 2023 to $2.50. But for 2022, it's $1.88 per square foot, new construction, commercial property. That's the first thing. The second thing you want to be aware of is something called the 45L energy credit. Now, this energy credit is specifically for residential units. So remember, the 179D is for commercial. The 45L is for residential units, and it's a credit, not a deduction. So let me just, for your listeners who may not know the difference, a credit comes right off your tax bill. So if I go to my CPA and they say, Erik, you owe $20,000 in taxes, if I have a $6,000 credit, I now only have to pay $14,000. The 179D is a deduction, which means that comes off your taxable income. Yeah, exactly. So if I make $100,000 a year, but I got a $60,000 deduction, instead of being taxed on $100,000, I'm now only taxed on $40,000. So that's the big difference between the 179 and the 45L. Is the 45L is a credit, which is great, and that is for any residential units, new construction, that meet or exceed the energy qualifications, again, established by the IRS. They have to be certified by a third party, but it's a $2,000 credit per dwelling unit that you're eligible for. And those I can't tell you, Corwin, how many times I've met with large home builders across the country, developers, who have never heard of it, never taken advantage of it, and they've got hundreds of thousands of dollars of credits sitting out there that they're going to lose if they don't take advantage of it by a certain time frame. So again, that's really for your clients or your listeners who are building either new construction commercial or new construction residential.
Look here, you just blew my mind with that, because man, look here. I mean, you're talking. I mean, that's substantial savings.
Yeah,
and up to, you said $2,000 per unit.
Per unit, yes. So if I'm a developer and I build an 8-plex, that's a $16,000 credit if I meet this certain criteria. And I must say that just because most counties and the material that we use now in construction, plus most counties have pretty strict guidelines on how efficient the materials are that you use in construction. So it's pretty easy to qualify for these credits. And so again, if you're a developer or a home builder, even an investor, if I'm an investor and I pay you to build me an eightplex, I'm the one that's eligible for those credits. And so for your investor clients out there who have new construction, it's definitely something worth looking into.
Boom. Going. Wow. So this is something that you guys, obviously you study, Erik, you guys are extremely versed in. So let's talk about other places, if you don't mind,
Sure.
that, you run into where people are quote unquote leaving money on the table. I mean, we're in quote unquote, New Year's to, about mid-April is quote unquote tax season, even though most investors and other people, extend and, may do this later in the year. But where are some other places where people in these types of scenarios are leaving money on the table?
Yeah, I think we'll go back. The biggest one, I think, is cost segregation and that depreciation. So if you meet with your tax advisor or your tax preparer and they say, okay, Corwin, you owe, $100,000 in taxes this year. If you own real estate, I would get a second opinion, because right now the tax law is so favorable for real estate investors. You should be paying very little, if any, taxes as a real estate investor, assuming you've got a portfolio of properties or even just one property. And to give you an example, if you take, actually, I've got my calculator here. If you take 1/39th of a deduction, your standard deduction, you're going to get about a 2% of your building value as a write-off in the first year, 2.5%. If you do cost segregation, you can get as much as 30% write-off in the first year. So you're getting 15 times the write-off. Now, again, on $1 million building, if I take $1 million, divide it by 39 years, I'm getting a $25,000 write-off every year. If I do a cost seg study on that $1 million building, I could get as much as a $300,000 write-off versus a $25,000 write-off. And so, again, some CPAs are unaware of CPAs. I look at CPAs kind of as general practitioners. They know a little bit about a whole bunch of different topics. They got to know about audit. They got to know about child tax credits. They got to know about real estate. They just don't have the bandwidth to dive deep into depreciation. And so that's why they'll usually partner with a firm like ours, because they don't know how to do these studies. And they don't know a lot about, they've heard about cost segregation. They don't know how it applies. And so getting with a CPA who understands this, and again, if you own real estate and you're paying taxes, I would have somebody take a second look at your tax return, because if you're not doing cost segregation and you own real estate and you're paying taxes, I think there's an opportunity there for you to save significant tax dollars.
That is, and so, you touched on something that general practice. So, typically your tax professional, like you said, is very high broadband, like going to a doctor versus a specialist.
Right.
You got issues with your feet, you go to a podiatrist, that kind of thing. So this is getting deeper into, well, if you're a real estate investor and you are continuing to invest, then one conversation that I have oftentimes with investors and stuff that we work with, okay, well, hey, who's doing your taxes? And are you using someone who is specialized and understands and knows real estate?
Right.
And what you did is quote unquote, peeling the onion over here, taking layers off this thing. And as we get deeper and deeper towards the core, you are, Erik, man, you dropping some jewels and some nuggets. So if you were a beginning investor,
sure,
let's start there. Beginning investor. First of all, should they engage with you first before they engage with a CPA? Is that what you would advise?
That's a great question. And I think it goes back to your relationship with your CPA. If you've got a CPA who specializes in real estate, which I would advise all the listeners, if you're buying real estate, owning real estate, find a CPA who understands real estate. There's a difference, Corin, between a tax preparer and a tax strategist. A tax preparer takes all your W-2s, all your K-1s, all the documents, they process them through their machine and they spit out and say, this is your tax return, right? They don't look for different ways to reduce that tax liability. They're just taking the input, creating an output. Those are tax preparers. You can go to Walmart, go to H&R Block. They'll do that for you for a small fee. A tax strategist or a tax planner says, okay, Erik, you own real estate. You made this much money. What deductions do we have available to us? What options do we have? Do we need to go out and buy another property before the end of the year to get some additional deductions? Or maybe we don't sell a property this year. Maybe we sell a property next year when you're in a lower tax. There's all these different strategies to lowering that tax. Well, so that's the first thing. As a new investor, you probably can get away with doing your own taxes, or maybe having a CPA who doesn't specialize in real estate when you maybe have one or two properties. But as you start to build your portfolio, it's very important to get a CPA who truly understands this stuff. And I would say if you're a real estate investor and you're paying taxes and your CPA hasn't mentioned cost segregation, it's probably time to start looking for a new CPA, because that should be one of the most commonly utilized strategies to reducing your tax liability. And so I don't know if that answers your question, but I would start with your CPA. We work with CPAs and building owners. And if a building owner does reach out to us directly, we always get their CPA involved, because we don't know everything about your tax return. We think we might be able to save you money, but maybe you've got some losses that carried forward from last year, and so you don't need an additional loss this year. Then let's talk about that with your CPA. But we always want to partner with the CPA as early in the process as possible.
And that makes perfect sense. I mean, because at the end of the day, you're here to provide a service. You're here to help people. And in order for you to be of help, you got to understand the situation. Somebody who is floundering in the water, flapping in the water, maybe standing up in the water, maybe they're making noise. Right. Maybe they're trying to make bubbles or waves or something. Who knows? Right. But sometimes we jump in the water trying to come to the aid of someone who doesn't need your help. So that's perfect situation right there. So let me take you back a little bit. So you've been in this field for a while.
Right.
I think I kind of asked you the question already, like, where are other places that people are leaving money on the table? And we've also kind of come around and said, okay, look, engaging you guys on the front end and then bringing in your CPA to kind of make sure everybody's on the same page is always a very, very, very good idea and a very good strategy. But let's say this is you. All right. So this is you. And tell our listeners what you would be doing in this season. So right now we got a market that is, if you're looking at an asset or looking to acquire an asset, is that something that maybe as they look at it from a futures tax strategy that you guys could engage in the beginning before they even look to pursue it? So look, maybe I'm going to develop this property, or maybe I'm going to looking to acquire this property. I want to know about the potential taxes or taxation and tax savings. Is that something that you guys do as well?
Yeah, absolutely. So I would always encourage any investor before they purchase an asset, as part of their due diligence, when they're trying to figure out, okay, what's my return on this asset going to be? Always factor in the tax liability or the tax benefits of that property, because sometimes they're significant. Like I shared in that example with the $1 million building, if we created a $300,000 deduction versus a $25,000 deduction, that $300,000 deduction at a 30% conservative tax bracket, that's $90,000, almost $100,000 in tax savings. What does that do to the bottom line? I know investors, for example, who will look at a property and go, yeah, it's not cash flowing a whole lot, but this particular asset class, I can get huge deductions, which creates huge tax savings. And so maybe I take it on a smaller return. I might not get the big return that I wanted in terms of cash flow, but guess what? I just saved $100,000 on my taxes this year, or $200,000 or $300,000 or whatever the number is. And so most cost segregation companies will always do a free analysis before you ever purchase a property or before you even acquire the property. So have the numbers run so you can say, okay, if I purchase this property, yeah, I might have a little bit of cash flow, but look what this does on my tax side. Oh, wow, it's going to save me significant tax dollars. I might be okay just breaking even on this property because you know what? I just saved $300,000 in taxes. And so it does kind of change the conversation when you understand how the tax implications work on any given property.
And, what you just made mention of there is huge because, oftentimes, we focus on the investment is about the return. Sometimes we want the return to be cash flow, but sometimes it is actual tax savings. The way in some instances, I mean, to be blunt, that's always a good thing. I mean, if you're self-employed or you're living from investment income, then your income from investment is taxed differently than the income that you work for. If you can build in, if you will, some tax savings that then lowers your tax liability and creates a margin that you otherwise wouldn't have, that's a win-win all day.
Right. No, absolutely. And again, that's a different way to look at it, but making sure you've played that or looked at the tax card in terms of saying, what is my tax implication? How does this factor into my overall return on my investment is very important. And it could be lowering your taxes. A lot of investors right now are looking for cash flow. And so one thing they're doing is, hey, I'm going to have to pay $80,000 come April 15th. I can give that to the IRS, or I can do a cost seg study, save that 80,000, take that 80,000 and go put it down on a new property. You know, where do you want to give your money? And so it's a great way to generate cash flow by reducing your tax liability. It in turn creates cash flow.
That's massive. That is massive. So Erik, you dropped a lot of jewels and a lot of nuggets. So I'm going to ask you this, and as we get, you know, pretty close to end of today's show, what is the key takeaway that, you know, if you had to say to our listeners, you know, quote unquote, one thing or series of things, what are the key takeaways that you want to leave with our listening audience today?
Yeah. And I don't mean to sound repetitive, but I'll say it anyways. The one thing I think that you need to do is know your strengths and know the strengths of your CPA. And why I say that is your CPA might be a great bookkeeper, but if they don't understand real estate, you need to find somebody who can advise you and your CPA on real estate. And so knowing your strengths, don't try and be the jack of all trades is the master of none, right? And so you got to know your strengths and you got to know your weaknesses, and it's okay. And you're going to pay for your weaknesses. You're going to go out and pay somebody, and you're going to pay him a nice fee. But I would rather pay somebody $2,000 to do my tax return if it saves me $50,000 in taxes versus going and doing it myself on TurboTax for a couple $100s, right? You got to find value. It's not always looking at the cost. Yeah, to find a CPA, a qualified CPA, I'm going to pay more up front. But if they can generate a $50,000 tax savings on the back end, it was worth all $2,000 I paid them up front, and probably more, right? And so just understanding that, I think, is so important. I see way too many people sticking with the same CPA that they've used for 30 years. Well, 30 years ago, you didn't have a portfolio of 100 properties. You need a new CPA who understands how to take that portfolio and maximize your tax savings. And so getting a good CPA who understands real estate, I can't emphasize the importance of that.
Understood. You know, that's one of the things that we really talk about and focus on, Erik, here on the show, is about mindset and mentality. And you know, as we are, you know, with our listening audience, as we're engaging and bringing in higher level thoughts and processes, that's all key. Because as you may mention, sometimes it is necessary to evolve, and maybe it's time to introduce you to their accountant to say, hey, look, let's take this thing up a notch. Let's start breaking this thing down and seeing where we could save more money, where we can, quote unquote, you know, savings is an increase in cash flow. I mean, the reality is if you've already allocated for it. So like you said, you allocated this money for this. Now I don't have to pay that. I can reinvest this money elsewhere. And then I can keep going and keep going and keep going. That is huge. That's huge. So Erik, I appreciate you being on with us today. If you don't mind, now, listeners, guys, look, I'm going to advise you. Number one, I need you guys to go to our website, Exit Strategy Radio Show. I want you to go there. I want you to make sure you subscribe, so when this episode is released, you're able to get it right there. Okay, Exit Strategy Radio Show. Please make sure you subscribe. I want you to make sure you take down Erik's contact information, and I need y'all to call him. But Erik, I want you to tell our listeners right here on air how they can get in contact with you.
Yeah, that's a great question. The easiest way is just through our website. So our contact information is all out on our website. Our website is just Cost, C-O-S-T, Seg, S-E-G, authority.com. You can get my email, my phone number. You can get the team's email if I'm not available. But please use this as a resource. We don't bill by the hour. We want to answer any questions we can to help you guys better invest and to help grow that wealth faster. So please use this as a resource. If your CPA has a question, you can give them my contact information. Happy to jump on a call with you and your CPA, go over these different strategies. But information is key. And so being able to get access to the information, don't hesitate to reach out to us at all.
Wonderful, wonderful. So Erik, thank you so much for being on the show. Thank you for being a part of the Exit Strategy Radio Show family. Guys, to our listeners, guys, thank y'all for tuning in. But y'all, please, let's take this up a notch. We cannot continue to do the same old thing, the same old way, because if so, then we'll get the same old results. And we got to take this all up a level. This is how we build wealth. This is how we expand and grow our legacy. This is how we, as we talk about in the very beginning of our show, this is how we right here leave an inheritance for our children, our children's children, so forth and so on, guys. That's what our word tells us, and that is what we do. So, Erik, one more time, man, I greatly appreciate you being on today. Thank you for taking time out of your busy schedule to bring this knowledge, this wealth of information to our listeners right here on our show. Our listeners, y'all know how I feel about you. Y'all know what I say, but I'm going to put all that together right now, and I'm going to say it to you this way. I'm going to tell you I love you. I'm going to tell you I love you. I'm going to tell you I love you. And I'm going to tell you one final time that I'm going to see you guys out there in those streets.